This is the story of what happened when the era of aggressive acquisition-led growth met the hard reality of a shifting fiscal landscape in Canada. For nearly 2 decades, Lightspeed Commerce served as the standard bearer for Canadian tech ambition. From its headquarters in Montreal, the company executed a relentless global expansion strategy that saw it spend nearly $1.5 billion to acquire competitors across multiple continents. However, in 2024, a convergence of new federal tax policies and a volatile macroeconomic environment forced a fundamental reassessment of that path. The company's journey from a high-speed consolidator to a disciplined operator marks a quiet but profound shift in how the digital economy functions. It is a transition defined not by the roar of new deals, but by the analytical precision of capital efficiency and a renewed focus on internal stability. The mechanics of this shift were set in motion by the 2024 Canadian federal budget, which introduced a significant change to the capital gains inclusion rate. Traditionally, only 50% of capital gains were subject to taxation in Canada. The new policy proposed increasing this rate to 66.7% for corporations, a move aimed at capturing more revenue from high-value asset disposals. For a company like Lightspeed, which had built its empire on the strategic movement and disposal of capital through frequent mergers and acquisitions, this change altered the fundamental math of future growth. Although the government eventually deferred the implementation date of this specific rate hike to 2026, the psychological and strategic impact on the tech sector was immediate. The policy signal was clear. The tax environment for major corporate exits and equity-heavy expansions was becoming increasingly restrictive. This legislative backdrop coincided with a leadership change that signaled a total pivot in corporate philosophy. In February 2024, founder Dax Da Silva returned as CEO, replacing JP Chauvet. Da Silva's mandate was explicit: steer the company away from the growth at all costs model that had defined its IPO years and toward a strategy of profitable growth. This was not merely a change in tone, it was a structural overhaul. Under Da Silva's new direction, Lightspeed initiated a strategic reorganization that included a 10% reduction in its workforce, affecting approximately 280 employees. The goal was to eliminate the operational redundancies created by years of rapid-fire acquisitions and to focus resources on the company's flagship products in North American retail and European hospitality. The necessity of this shift becomes clearer when examining the broader global context. In the years following the 2019 IPO, Lightspeed's acquisition blitz included major deals for companies like Shopkeep, Upserve, and Vend. These moves allowed Lightspeed to enter new verticals and geographies with staggering speed, but they also created a fragmented ecosystem of disparate software stacks. As interest rates rose globally and investor appetite shifted toward companies with fortress balance sheets, the complexity of maintaining multiple platforms became a liability. The market began rewarding the Rule of 40, a metric where a company's combined growth rate and profit margin exceed 40%. For Lightspeed to achieve this, it had to stop looking outward for new territory and start looking inward to maximize the value of its existing 160,000 customer locations. By April 2024, the company's new financial discipline was evident. Alongside the workforce reductions, the board authorized a share buyback program for up to 10% of its public float, representing approximately $140 million. This move was a direct communication to shareholders. The company believed its own stock was a better investment than further speculative acquisitions. Analysts at TD Cowen noted that this restructuring was a clear sign of high focus on profitability, which also made the company a more attractive candidate for a potential take-private deal. The focus had moved from conquering the world to protecting the kingdom. The real-world impact of this shift is visible in Lightspeed's financial results through 2025. For the first time in its history, the company surpassed $1 billion in annual revenue, but more importantly, it reported a substantial jump in profitability metrics. Adjusted EBITDA reached $53.7 million in fiscal year 2025, a massive turnaround from the near break-even performance of the previous year. This was achieved by migrating the vast majority of acquired customer bases onto two unified software stacks, the R-Series for retail and the K-Series for restaurants. By standardizing its technology, Lightspeed was able to drive higher average revenue per user through the deeper integration of its own payment processing services, which saw a 19% growth in gross payment volume. However, the transition has not been without its challenges. The consolidation of customer locations and the shift toward higher capital-efficient segments resulted in a net decrease in the total number of locations as the company pruned smaller, less profitable accounts. This trade-off, sacrificing raw scale for high-margin stability, is the defining characteristic of the new Canadian tech landscape. The 2024 policy shift acted as the final catalyst, forcing companies to move away from the unicorn-chasing mentality and toward the centaur model of businesses that generate $100 million or more in annual recurring revenue with positive cash flow. As we look toward 2026, the implications of this shift are ripples throughout the entire North American fintech sector. Other major players are closely watching Lightspeed's unify and monetize strategy as a blueprint for survival in a high-interest rate environment. The Canadian Entrepreneur's Incentive and the increased lifetime capital gains exemption introduced in the same 29-24 budget were designed to soften the blow of higher taxes for small founders. But for large-cap firms like Lightspeed, the era of using acquisitions as a primary engine for growth is effectively over. The company is now leaning into organic growth engines, targeting a 15 to 18% consolidated gross profit growth through 2028 without the need for additional billion-dollar buyouts. This narrative represents a significant maturation of the technology industry. The quiet shift at Lightspeed reveals that the true power in the next decade of software will not belong to those who grow the fastest, but to those who can extract the most value from the systems they have already built. The company's pivot from an expansionist power to an efficiency-driven leader reflects a broader global cooling, where the cost of capital finally demands a seat at the table. In the end, the story of Lightspeed's policy-driven shift is a reminder that even the most ambitious global plans are ultimately subject to the gravity of domestic fiscal reality. The under-discussed reality of this transformation is that it actually strengthens the company's competitive positioning in its core markets. By focusing on North American retail and European hospitality, areas where Lightspeed has a documented right to win, the company has been able to increase its investment in product and technology development by over 35%. This ensures that while the geographic footprint might not be expanding as rapidly as before, the depth of the tools provided to merchants is increasing. New innovations in AI-driven pacing intelligence for restaurants and advanced loyalty modules for retailers are now the primary drivers of value, rather than the acquisition of another competitor's database. As Lightspeed concludes its strategic review process in 2025, the company emerges as a leaner, more resilient entity. The board's decision to authorize an additional $300 million in share buybacks signals a continued commitment to returning capital to investors, rather than burning it on expansion. This disciplined approach has successfully stabilized the stock price and regained the trust of institutional investors who had grown weary of the volatility associated with the acquisition-heavy years. The journey of Lightspeed serves as a potent case study in how a company can successfully navigate a hostile policy environment by doubling down on its fundamental strengths. Ultimately, the shift in Canadian policy did more than just change a tax rate. It changed the definition of success for the nation's tech leaders. It signaled the end of the land-grab phase of the internet economy and the beginning of the operational excellence phase. For Lightspeed, the pivot away from aggressive expansion was not a retreat, but a strategic repositioning for a more sustainable future. The company has moved from the noise of the headlines to the quiet, steady rhythm of a profitable enterprise. As other firms face similar pressures, the lessons learned in Montreal over the last 24 months will likely become the new standard for the industry. The era of the high-growth documentary may be ending, but the story of the high-efficiency institution is just beginning.